Despite the Federal Reserve's decision Wednesday to cut rates for the third time this year, several prominent market strategists see a big stock market sell-off in the near future. Peter Cecchini of Cantor Fitzgerald expects the S&P 500 index to be at 2,500 by early 2020. That's a plunge of about 18%. He sees bearish manufacturing and consumer data making a recession likely by the second half of 2020. Albert Edwards of Societe Generale says that stock prices have been advancing faster than earnings, and he finds this to be similar to the dot-com bubble. Meanwhile, interest rate cuts by the Fed appear to be losing their potency, as the Wall Street Journal has reported. Among other reasons, the journal has pointed to widespread uncertainties about global growth and trade tensions that are making corporations hesitant to invest, even if they can borrow at lower rates. Jumping on the bandwagon are many investment managers who have also become increasingly bearish. This per the latest release of the Big Money poll conducted by Barron's. Among respondents, 31% are bearish on stocks. That's the highest level since the mid-1990s, while only 27% are bullish, less than half the proportion 1 year ago. Individual investors, also polled by Barron's, are similarly gloomy, with only 29% calling themselves bullish and 42% believing that U.S. stocks are overvalued. So, are we heading to a stock market collapse? Well, let's take a look. If you're thinking that the market is going to collapse, let me tell you that the third time just may be the charm. I'm speaking of the recent interest rate cut by the Fed Reserve that happened on Wednesday. Although there may be some concern about the Fed delivering another dose of monetary easing to a stock market that is at or near record highs, history says the market may just have other plans. According to the data from LPL Financial, the market tends to extend its gains after three successive interest rate cuts of a quarter percentage point. That is shown here in this chart. As we now know, the Fed Reserve cut its benchmark interest rate for the third time this year to 1.5 to 1.75%. However, the central bank also indicated it will pause before acting again. The vote to cut rates was 8-2. Now the next question is, what have been the returns in those periods in which the Fed has delivered three interest rate cuts of 25 basis points? Well, based on the data, in the 6 and 12-month period following those rate cut decisions, the market has done quite well. The data from LPL shows that the S&P 500 index has been up 10% a half year later and 20% a year out. This data comes from three time periods, 1975, 1996, and 1998, where there were three initial 25 basis point cuts. These kinds of returns may be hard to believe given the current stock market levels and following the equity gains so far this year. As we know, the S&P 500 is up by about 21% in the year to date. The Dow Jones Industrial Average is up by about 16%, while the Nasdaq Composite is up nearly 25% over the past 10 months. But as you should all know by now, I've been calling for the market to continue upward since this past summer, so no surprise for me. There is a possibility the data and I can be wrong, but if I am, I'm sure the Axeman will let me know. But in my humble opinion, the greater probability is for this market to continue up. Now, following Wednesday's decision, the market isn't expecting another rate cut until maybe February of 2020. So, where will the market be by then? Well, subscribe and stay tuned. And so for today, That's ChewDog Charts. Thank you.